So volatility is your friend. When market is down, that is the best time to invest, and this is what add on to your profits.
So, welcome back, listeners, to another episode of Economically Yours. Today, we have with ourselves Aprajita Sharma. She is a financial journalist and a certified financial planner. She has a decade-long experience in covering the equity market and personal finance beats. She has extensively written on stock market trends, mutual funds, startups, and financial planning, among others. She now freelances for Mint, Fortune India, Outlook Money, and Singapore's Business Times. So, before we talk about India's equity growth story or something related to India's equity, I would like to know, when did you start your career in finance, or when was that peak point where you knew that finance is going to be your mainstream focus?
So, since very beginning, so from the day I decided to enter into journalism, and from the very day that I started preparing for journalism colleges, I had this thing in mind that I'm not going to get into political journalism or any other field. I'll stick to finance. So so before joining my institute, I used to write on financial topics. So each week I'll decide on a topic, reading newspapers, I'll come up with a topic that this is the one that I'll be researching about through the week, and over the weekend I'll write it. I had created a blog, so I would put those topics there, the write-ups that I had written. So that's how my journey into financial journalism picked up, even before I got into IISc, Indian Institute of Mass Communication.
I think this resonates with my current story because I am right now, I've just entered the markets before 2.5 years, and there's this new chaska of blog writing and podcast creation and everything has also come into place. I'm looking forward to a great success story as yours then if it pans out.
All the best for you.
Talking about success story, one word that's coming to the mind of investors these days is nothing but India, right? That like anyone and every investor that come across today, people are saying that boss India mein paisa banega, and India is the place to be, and India mein invest karo, and stuff like that. So now we understand that every country grows, but each country grows at its own pace. Now, for India to grow at an exponentially, at an exponential pace, there are certain policy changes required, certain developments required, and the likes. Having said that, we recently came out with the union budget. What are your views on that? How would you rate this particular budget that came out? The changes, like the the new regime that came out, the tax change on premiums and the likes. What is your take on that?
So yeah, I would say from speaking from stock market perspective, then I would say that budgets are, these are just regular annual affairs. One should not focus too much on budget announcements as such. How so? If it's out, focus on the broader developments. What are the key highlights, etc. So at the most, it will impact your stock market developments only for 2 or 3 days, not beyond. So in this budget, the major broader picture that one should look at is focus on fiscal consolidation. That government maintained its fiscal deficit target for FY23, which is I think was about 6.4%, and for FY24 they have announced it for 5.9%. So this is important that government is not they are not taking populist measures as we feared. Before budget came out, there were so in the stock market investors and experts, they were talking about this being election year and government coming out with populist announcements, but it did not happen. So which is something positive that one of the important takeaways. And second important point, that government is really serious about capex plan. So last year also they hiked it about I think 7.5 lakh crore, and this year 33% jump, about 10 lakh crore. So this is another important development. And after, if government is focused upon expenditure, then obviously then private companies will also do the same. It's a cycle. So this is another important development. And then talking about new tax regime. Now it seems that they want to take away, they want to phase out the old tax regime, and in new tax regime you have tax free annual income up to 7 lakh. So it will boost consumption in economy. So this is again a broader positive development that we should focus on. And again, about rich. So this is what middle, lower income group. And about rich, so higher effective tax at 47.2, 42.7% it
Yeah,
used to be. And now it has come
right.
down to 39% from FY20.
39.
So these are few important points out of budget that one should focus on. But and another thing, so we talk about what all has happened. What hasn't happened is equally important. So all people we had in mind that LTCG will get hiked or
Oh,
aligning
yes.
LTCG
Yeah.
among different asset classes. So it did not happen. So this is again a positive development. Yeah.
So, keeping all the positives in mind, the retail euphoria has still fizzled out. Like, keeping COVID in mind, it was at its peak around 67%, if I'm not wrong, and now it has gone down to 44%. So, what is the reason behind that, or what are the long-term drivers that have failed to, keep the euphoria high?
So retail investors, it's a cycle that once market is going up and lot of people are coming in, and even everybody, your colleagues maybe or your neighbors, everybody when they are talking about markets, that is when you see this retail jump. But this time, what has happened? Yes, demat number of demat accounts, new demat accounts are going down. Number of active investors going down, but flows in mutual funds have been consistent. So that is really amazing. And it hasn't happened before. This is for the first time we are seeing that mutual fund investment SIP flows are consistent. They are nearly about 14,000 crore these days, monthly inflows. So which is really positive that at least long-term investors, at least mutual fund investors, they are serious about it and their SIP flows are consistent. But talking about stock market trends, because a lot of people come into markets with that short-term money making thoughts. So if it's not happening, then obviously people will exit. And with Adani, the issues in Adani Group and lot of and globally also you have inflation fears and interest rates are going up. So these are the reason. And another important point around COVID, when COVID happened, then interest rate were already way too down. Around repo rate was at 4%. So bank savings rate just 2.5% at SBI, and then fixed deposit rates also quite low. So when you had no other safer investment avenue, higher interest bearing investment avenues, then people moved to stock market. But now that interest rates are going up, then obviously if you have FD rates giving you 7%, 7.5%, then obviously people would not want to take risk, and that too in such uncertain environment. So this is main point that interest rates are going up, so your fixed income FDs are better, attractive, much better than equities. So yeah, it should not happen because if equities are trading at lower levels, then obviously people should stay invested. But obviously people look at how headlines hit in newspapers or TV channels.
Right. So, I mean, talking about these, right? So, one thing that I've recently discovered that thanks to my mentor where I work, right? He very well explained that, see, currently Nifty P is around 22, right? 21. It's been ranging between 21 and 22 for the last 2, 3 months, right? For fixed income, even if we consider a scenario of say 6%, that a person is getting a 6% on an FD, considering that investing rupees 100 gaining 6% returns, that gives you a PE of about 17.
Hmm.
Now FD in fixed income P being at 17 and equity markets P being around 21, I think that makes equity markets look very, very attractive given, laying out these two numbers. But then again, as you mentioned, that investors are serious, but the short term noise that is there in the market, this euphoria that Darshan mentioned about, I think it was majorly because of the traders that came in and realized कि boss paisa nahi bal raha hai ab. And now because they haven't seen the other side of the market, they came into the markets only when the markets were rallying and stuff like that. I recently also read a report by SEBI that mentioned that in the FNO segment, which is there, and they, I think, surveyed some top 10 brokers. 89% of the traders have incurred losses. Yeah,
Huh.
and that's a huge number. It blows your mind. I mean, people are just absurdly putting money in the stock market. So, what do you have to say about this on the retail investor segment? The dissection between trading and investing that's there.
So any or every investor, they when they enter markets, then they look at it as quick money making machine. So they come with their trading mindset. They don't enter with investing mindset. And in trading, then you had all these YouTube channels and Instagram and Twitter accounts and telegrams where quick small, stock tips were being given, and people would showcase their trading profile, their trading, how much money they have made in a day, all those things. So people get attracted towards it and they get into it. But now, as you may have also observed, that SEBI has been taking strong action. Just day before yesterday, Moneywise and some other accounts, they have banned them from
Yeah.
trading. So all these things are happening. So retail investors, they are under apprehension. They don't want to get into stock market, but that is the moment when they should understand the difference between trading and investing. That trading FNOs are hedging device. It's not for you to make money. If you are invested in cash market, then you should hedge your portfolio against in derivatives. So that is the main reason why you get into FNOs. It's not for you to invest your hard-earned money and earn quick profits. So this is the time that they should understand it. And investment equities are always for long term. It's not for short term. So one has to understand it. So this is the difference between trading and investing. And trading, if you want to get into trading, then that is fine. You need to just understand the basic principles and you need to focus on it through the day. If you have some other job going on, if you are into full-time job, then you cannot trade, and you should not rely on brokers and others for them to do your job, because everybody will have their vested interest. So brokers will obviously want to offer margin money, so that on less amount, you have less amount, then they will give you margin money, and then you may, but losses will also be quite huge. If profits pool look high, then obviously losses can also be quite huge. So investors need to understand that, and with that mindset, you need to understand trading versus investing and equities for long term if you have a full time job. And if you really want to be a trader, then leave your job and simply stick to it, like others, big traders did in the stock market. So, yeah.
So given your long career in finance, what are some of the key lessons that you learned from the market that the market has taught you, and you could share that with our audience so that they can also get a cue and they also know कि हाँ ये करने से they'll be able to make returns, or they are sorted for the next 5 to 10 years in their lives.
Personally, I don't trade. I have never traded a penny. I have invested in good stocks that I find which have long term potential. So I'm invested there. But the very important, the major thing that I have realized through my own investments is that right after, I think around 2014 or 15, I started doing my SIPs. That was the first time when I invested in a mutual fund. And I made sure that whenever market is down, so any day market Sensex is down by 500,000 points, 1500 points, I'll go and add some money. So my monthly SIPs are on a fixed date. Whatever amount I had put it will directly get deducted. But any day if market is down, from my end, I'll go log in and put that additional purchase. And I think about a month or two ago, I was checking my XIRR. My XIRR are much higher than what Nifty Kaggle is. So because I kept investing on lower points. So this is very important. So people get, when market is down, then people are they are just get conscious that what will happen to me and all. So volatility is your friend. When market is down, that is the best time to invest, and this is what will benefit your profits. As in, this is what add on to your profits. So these little things people don't understand. They want to make quick bucks and all those things. They want to earn a 25-26% CAGR on their return, but it is easily doable if you simply stick to basic long term. So 2014, I started my investment, and gradually I could earn so much, and I did not realize that my mutual fund investments have grown this big, and I have earned more than what Nifty did. So because I kept investing at lower points. So this is one major important point. And um, again, so this, I think I should stick to this point itself because it speaks a lot about what people should do. If you are into a full-time job, simply run your mutual fund SIPs or simply invest in good quality stocks, Nifty stocks. So either that way or this way.
Right. So, talking about when markets are down and investing, markets have been, currently available at very attractive valuations, and this has been for a long period, like good 12 to 15 months now.
Hmm.
Having said that, what and this I'm talking about from the perspective of people who want to take a bit higher risk and want to invest into companies beyond Nifty 50, right? So what would you suggest, what are some of the parameters of stock selection that one should look at, retail investors especially, who are wanting to invest directly into stocks at good attractive valuation when the markets are not really overvalued but not really undervalued as well, and they're highly attractive. So some parameters that you would suggest that investors should look at before putting in money into any stock, be it a Nifty 50 stock or Nifty 500 stock.
Okay, so first one need to be observant. Just look around everywhere and observe where people. What sort of products are being used by masses? So you need to observe that. So first you figure out industry, something that you think has potential in near future, in long term. So you need to first identify that sector, that segment, and once you know that, then you need to come up with companies, which all are the companies involved in that business. Once you have it, now is the time to look into financials. Now these days, screener and all these public databases, free data is available very easily. So you need to check their ROE level, their ROCE, return on equity, and return on capital employed. If it's in double digit, if it's more than 15%, 20%, and it has been consistent, then this shows that this company has potential. Now, debt levels are very important. So in Adani Group, okay,
Adani.
but debt levels were quite high. So this was a red flag that as a retail investor, you should stay away from companies which are running high debt. But obviously, there are some sectors which cannot live without debt. That is like raw material for them. That is fine. But otherwise, you need to stick to companies with near zero debt levels. So double digit ROE, ROC, and zero debt, most important. So you need to get into fundamentals. And even if you have heard about any stock tip, maybe, and someone has suggested you any company name, no harm in considering that stock. Just that you need to have your own hypothesis. You need to get into the financials, just read up about the company. And if you think that you yourself think you have that conviction, only then go ahead with that investment. So obviously, if you are active in stock market, then you will get to know about different stocks, which companies are doing bad, which companies are doing good. So fine, you just take note of those companies and do your own research. Only then go about it. And if you cannot do that research, because as you mentioned that you want me to focus on beyond Nifty 50. If it's Nifty 50, no problem. Those are stable companies. Those will keep growing. If India has to grow, then those Nifty 50 companies have to grow. So that is fine. But if you are coming into beyond next 50 and other Nifty, maybe mid cap 150, so in that segment, you need to be very careful. And you cannot do your own research, then you have index funds. Now you have index funds, not just for large cap, but also for mid cap. So Nifty Next 50 is there. And beyond Nifty Next 50, you also have Nifty 150 mid cap index fund. So a couple of mutual fund houses. So Motilal Oswal was the first one to launch that one. And there are others as well. So if no other way out, if you can't do your own research, simply start doing SIPs in Nifty Next 150 index for higher growth beyond what a large cap would be.
Correct. And I think after the Adani scam, another factor that has also come up is the promoter stake. People are
Huh,
highly looking at that parameter also now.
that
But
is,
well said, I think some factors that you mentioned about ROE, ROCR, these are some, and a very good point on the fact that a lot of data is available freely today.
hmm.
And people are not leveraging that as retail investors, I thought. So, yeah, I think leveraging what's freely available is the first step towards information, and I think that, yeah, that works.
Yeah, and people should listen to transcripts and conference calls, what management is talking, what sort of questions all these DII investors are asking in those conference calls. So these things are also important, and all these things are freely available.
So you have rightly pointed out the basic fundamentals that one should look into before investing or selecting a stock for their portfolio. But there's continuous short-term noise, which you like said that the budget, it's like a short-term noise maybe. So how do you differentiate between short-term noise or short-term noise and long-term fundamental trends that one should focus on?
So I would say that there is only one long-term fundamental, which is India growth story. So if you know that Rakesh Jhunjhunwala sir, bull of Dalal Street. So he was highly bullish on India, always positive about India. So he has played on to it. And if you believe in India growth story, if you feel that your country is to grow, if you believe in your own growth, if you are to grow, then your country has to grow. So if you believe in that the world will always move forward, the country will always move forward, it will not move backwards. So this is the larger, broader trend that if India has to grow, its GDP has to grow. If its GDP has to grow, then top companies have to grow. Only then the country, the people, whoever, all big ones, biggies, and all lower strata, everyone has to grow. So that is the larger trend. Not talking about short-term blips. Short-term blips one need to avoid. As I said, there could be stock specific, there could be sector specific announcements or sector specific developments that may play out negatively. But broadly, stock market will grow, as we have observed that Sensex has only been gone up in the long run. Nifty has only been up in the long run. The market cap of all these top companies have been growing. So this is the larger trend that one should focus on. And all these interest rates, central bank doing this, recession, and all these things, short-term blips. 2016 demonetization happened, and then also we thought that what will happen to India, all those things, and then again it picked up. Then you had IL&FS crisis, so things keep happening. COVID, so it appeared that world is going to an end, but we are here safe and sound. So when we have overcome COVID, such a big development, then even COVID was a short-term blip. So that is a major takeaway that I would want to share with all viewers, that only one large trend, that is India growth story, and everything else is short term.
Right. I mean, I agree. I completely second to that thought that India is the place to be, right? Like we discussed. But I mean, how much can we speak about it? We know that India is the place. We have to invest in India, but where to invest? I know
Hmm.
these are the parameters that I have to look at before investing. I know this is the source where I log in to understand these parameters. But do we have a layout of some sectors that have a potential to grow more than others?
Hmm.
A particular industry that can outgrow any other industry that's existing? Like technology today has become an industry in itself. A few years, I was just reading that I think 2016 or 2019, the entire e-commerce space in India was just about $6 billion.
Hmm.
Last week, India made just one deal of $6 billion in the e-commerce industry. That is how e-commerce has expanded in India. So, I mean, what are the some of the sectors that you think has the potential to play out in the next 5 years probably in India?
So for that, we also need to focus on key growth drivers which are happening in India. So the most important that India, we are talking about being $5 trillion economy, and India's growth. We are also different rating agencies. They have predicted, even RBI, that we'll grow at about 6%. Different agencies have different estimation, but nearly 6% is what we will grow in FY24. And world GDP growth about, I think, 2%. That is what World Bank has projected. And then other countries, they might get into recession, negative growth. So India is an oasis, and global investors, everybody is looking at India, then our demographic. So consumption is a big theme that we should focus on. So in consumption, you have FMCG sector, you have consumer durables. So these two sectors look good for long term, for near term, I should say, near to long term, because consumption growth story will play out in India. Now, financialization of economy. Lot of people are coming into markets through mutual funds, through various means. Financialization includes everything, even insurance companies. So all these this BFSI segment, banks. So we will always need banks. So if you are coming into one sector, then also you need to focus on stronger players. So FMCG, consumer durable, banking, and the entire BFSI space is one should focus on. Now, digitization. So now digitization has two parts. One, you have all these companies, all different sectors, manufacturing, infrastructure, all these companies are trying to digitize themselves, their day-to-day operations. So if that will happen, then your IT sector. And in IT sector, then you can get into in which sector, which company is active. So they have all these verticals. So you need to focus on which IT company is active in which vertical, and that is how you can pick your stock. So IT is again an important sector to look at. Now, another major development that is happening in India is about digital public infrastructure. So when we have UPI, and now UPI accounts for 40% of cross-border payments globally. So 40%. So UPI is making amazing strides. And beyond UPI, now you also have account aggregators and OCEN, all this public infrastructure that is happening. So with account aggregators are already live, and as they pick up, so digital data sharing, all these being digital, things will move at quite fast paced, and then credit will grow in the economy. So this is linked to IT and also with the BFSI. So these are 4 or 5 sectors that one should really look at. And then, as in the beginning, I mentioned about capex. So you also need to focus on which all are the segment infrastructure within infrastructure, which are the industries where government is spending money. If that is happening, then again, railways also got really good capex this year. So all this segment also one should focus on.
So there's a lot of information that one needs to, keep track of, like ye dekho, wo dekho, look at all the fundamentals. So what is that one source of information, that you advise to retail investors, to keep track of all that's happening in the markets?
So one needs
Or how do you keep track of
one needs to read newspaper, at least 1 or 2, 3 newspaper, at least 2 one should read on daily basis. Not TV channels, but newspaper, because newspaper, and don't track it online. E-paper is fine, but if you are consuming your news from website, so website keeps updating through the day. So you need to have that full-fledged information that is coming out on daily basis. So reading newspaper is very important. So sometimes you have all those short snippets in columns, just very short snippets. Those are also very important. So you need to scan the paper, not what you are consuming, scrolling down, but what is coming to you. So you need to not scroll, you need to just simply read newspaper on daily basis, sift through it, all headlines. If you are not going to read the entire piece of news, then at least you will read that specific headline that is there, so it will stick to your mind. So this is how you should consume news, that what is happening. For larger trend also, there are long form pieces. Edit page is very important in newspapers that you should focus on. So this is one advice that I'll give. I am a print journalist. I have recently started doing videos, but I'm a print journalist, and I would say that this is how I have grown in my career also, reading newspapers daily.
Right. Okay. Now this sounds very old school, right? Reading newspapers, especially for people from our generation who want everything, at their fingertips. Like, if I asked, like, I'm 28 today, but if I asked a 20-year-old to sit and read an entire 16 pages newspaper, they'll probably mock me. They're like, I can just read something that comes at my
In
fingertips.
shorts.
Yeah, in shorts is the place to be at, right? It's the app that I need, nothing else. But again, talking about apps and everything, and we talked about technology as a sector, right? AI is upcoming. AI is the new in thing these days, right? But now, along with AI, comes the hazard of unemployment as well, if I may say. Uh, what is your take on that? Like, I see a lot of content writers today just gaining fame through AI. Like ChatGPT today, it got, I mean, it boomed up crazily, and people, I myself have used it, and I am amazed by how that bot works. So, do you think that, uh, the jobs of certain humans are at risk because of AI, and will certain businesses be impacted because of that, or, it's not the way around, at least for the near future?
No, I don't think that jobs are at risk. It's just that people need to skill themselves, keep growing, keep learning new skills. So in banks, if you observe that banks have their government jobs, so their jobs are secured. But the point being that you need to innovate yourself, you need to keep growing. So talking about journalism, so content writers and things have been discussed, that all these weather reports or company announcements, those can be easily written by bots. But what about thought process? What about the planning and observing major developments that are happening? So a human can do that, but a robot cannot do that. And we as humans have made those robots. So thing, and obviously we'll outsmart them. So one need to skill themselves as things are moving, but I don't think that jobs will ever be at risk if one is efficient enough to go along with how world is moving forward. So maybe writing code, etc., may get easier, but one needs. I don't understand much about coding and all how things
Yeah,
work
but
behind
at the
IT,
same time,
but
so even other bots are using these bots so frequently that now if I, go to ChatGPT, that AI bot will ask me to verify if I'm a human or not. So that is the irony that that particular AI bot is being used by so many other bots, that the traffic on those algorithms have increased crazily. So they
hmm.
are asking humans to first verify yourself as a human and then use my AI functionality. So this is where the
Right.
world has come down to today.
Hi. So, but
So
I
I've
fully
used
believe in humans, and they will always outsmart bots or any other technology.
so So I've used it. I've also used ChatGPT, and it has got it sometimes catches my emotions as well. But yeah, I agree to your point that we need to upskill ourselves. We need to grow ourselves, and I'm sure humans will outpace, and humans are outpacing the bots in that different
Exactly.
world that has just been created right
Exactly.
We discussed about the investor short term, the trading and investing kind of a framework, where the short term noise and the long term fundamental trends. We also discussed about the fact that the recent euphoria happened because of these traders who came in, and people who did not understand stock markets and who've not, seen them historically, and just entered during the rally, and now have fizzled out because of the calm that has come into the stock markets. But I want to also talk about those investors who have been there, say, who came into the market say in 2018, right? Who've seen the volatility in markets, the pre-COVID phase, 2 years of that particular period. They also saw the COVID period, the COVID downturn, then the post-COVID rally, and are now witnessing the flattened phase that is there. What are some of the takeaways that you feel these kind of investors, should probably keep with themselves, or some learnings that they should take from the market? You witnessed a particular, yeah, I'd say 4 5 cycles of the market downturns and upturns as well. So some of the lessons that you want to, bring out on the table for them.
So, if these are the target audience, then I suppose that they would understand that volatility is their friend, that they may have made money through all those cycles. And another important point is asset allocation, that don't just stick to equities. If equities are going down, then as we are witnessing that interest rates are moving up, then fixed income looks good. And if equities are down, then gold also start performing well. This asset allocation is very important, and not just among asset classes but also country. So one needs to invest globally as well. So if India has performed well, then global markets haven't. In 2020, as we have seen that India, I think 5 6% up jump in Sensex Nifty, but China market, US market down by I think 23%, double digit fall, high double digit fall in those markets. So the cycle will change. global markets may perform quite well this year, and India may not perform that well because on equities front, India is overvalued now compared to other markets. So these cycle keeps changing. So one needs to have asset allocation and also country specific diversification. So so such people 2018 and onwards, they may have missed that, but they should focus on asset allocation. Manage your return expectations. So one should not have that thought in mind that you will double your money from stock market as such. So very simple, basic return expectation one should have, that if these are giving you 6%, and if inflation is 7%, just suppose if its inflation is 6%, then 6% FD, 6% inflation, 12%. So you just need to earn 12% CAGR, 12% annual return on year on year, 12-13%. That is good enough from equity market. So that managing your return expectations is also very important. You need to have this sense in mind that how much are you going to get. So you no need to focus on 20-25% return. 10-11% beating inflation is simply good enough.
Great, great. I think that sums up, a lot about the retail segment euphoria, plus our dissection between trading, investing, and I think this sums up our conversation entirely. I think sums up for each and every retail investor that why they should not exit the markets at the current scenario, and rather take this as an opportunity to keep investing. And I mean, of course, in good stocks, in stocks they've researched about, and stocks they have conviction about, the stocks that have the potential, the businesses that have the potential to grow. Having said that, I think we've had a pretty well summed up conversation regarding the retail segment. So thanks for doing this. We move on to the last segment of our conversation, which is the rapid fire round. So we'll have 5 words each from each end.
Okay.
Yeah. So I'll start. The first word being India.
An oasis in the world.
Budget.
Short-term blip.
UPI.
The most remarkable innovation from India in recent times.
Tax.
This is the way to go. One can't avoid taxes.
Capex.
Huge capex being planned, which is positive for economy.
Financial planning.
The most important thing for all millennials, Gen Z, Gen X, everyone.
SIPs.
The easiest way to grow your wealth, to be rich.
Long-term growth.
Is the way to earn wealth.
Investing versus trading.
Investing is for conservative investors. Trading is for who really can take risk, and trading is for people who can really manage risk well.
The last one from my side is Aprajita.
Invincible. Nobody can defeat.
I think that's the best one so
That's
far
the
we've had.
spirit.
Yeah.
Yes.
Great,
That's the
Aprajita.
spirit.
We're truly honored to have you on the show, and thanks for doing this. We are absolutely delighted to have you here.
Really, my
Thank
pleasure.
you. Thank you
Nice
so
speaking
much.
to you both. Really nice speaking to you both, and all the best. Keep doing such great podcasts.